Mentioned the Dow Jones Industrial Average hitting record highs.
And that may have a lot of you thinking about your investments. Joining us live this afternoon, certified financial planner Andrea Cave. So what does all this mean for the average person? How does this affect us?
Well, people don't want to get too tied to what the benchmarks are because it's not always an indicator of how your account has performed. There are countless studies that will tell you that emotions get the better of most of us. So oftentimes people at the time that they should be staying the course with those investments that unfortunately they may have lost money with. If you get to the sideline in cash or bonds, you may not have gotten a lot of what this rally is that we've had in the past 5 years. There is a study by Vanguard that says that 401k accounts, even including contributions, are only up a little over 2.5% per year on average over that 5-year period that the market has had a substantial recovery. So take a look at your accounts and readdress where you're at in your life cycle. If you're near retirement, if you've got a long way to go, that has a really big impact on all those things.
Now, because of this historical high in the market, do people now sell and try to capitalize on that? What should they do?
Well, I always try to caution people from trying to time the market. There is an adage that's old as time, and it's the best thing to always recall when you're thinking of your own investments. It's time in the market, it's not timing the market. So you could pretty much throw a dart at a wall and pick an investment. If you're there for a long period of time, you'll most likely make money. Stay in the course. As I said, if you're in a stock that brought you down, you've got to stay in stocks to bring you back up, because if you change positions, you may never get back to where you need to be.
What about retirement accounts? How does that affect retirement accounts, all of this?
Well, the retirement accounts, you have an automatic dollar cost averaging strategy when you are in a retirement account like a 401k. You're adding money continually all of the time. So when you have volatile years, which the past 5 years we've had a recovery, but there have been years that they've been choppy. You have a big gain, you give a bunch back, and dollar cost averaging allows you to buy more shares when the market's down, and that happens automatically through that type of investing. If you don't have a retirement plan at work, but you make contributions on your own, keep in mind that if you are investing on your own and you only do it one time a year, you're going to get the price at that point. But I would just encourage people, there's target date funds that by mandate all companies have to have that will shift your risk as you get closer to retirement. You can use those, but if you'd like, the people who tend to do the best are those who either use an automated strategy or work with an advisor, because we are all emotional people and we're really tied to our investments. So working with an advisor, they're not as tied to your money as you are. So that's a good piece of advice as well.
Help you make a rational decision.
Always good to ask for help.
Yes.
Andrea, thank you.
Got a question for our experts? Email them at asktheexpert@tmj4.com. You can also leave a voicemail. That number, 967-5253.
Oh, as